All right, well, welcome everybody. It is January 25th, 2022. It's been a few months since my last market update, and when I scheduled this video and sent it out on Friday with the headline "Market Volatility," I had no idea what we'd be in for on Monday and Tuesday. For those of you guys who don't tune into the market every single minute of every single day, we've had insane market movement yesterday and then today. The Dow, common measurement of market movement, was down over 1,000 points yesterday and then recovered to close higher. Same kind of story today. Dow down over 800 points and then is closing right about even or so. What we're seeing has really been present all through January, this heightened market volatility. We also saw it very much at the end of December. And so the idea behind the call today is to address this market volatility, because with those ups and downs comes a lot of fear and a lot of anxiety. Okay, so we're gonna talk about that head on, and then what our strategy really has been the last 4 months in preparation for a period of time like this. We're also going to take a big step back to have some perspective and look at other times of volatility over the last 15 years, because the same old is brand new again, right? This is always a part of markets. So let's jump in. Okay, so let's talk about a little bit of what the markets have looked like over the last 15 years since 2007. So going all the way back to the good old days of 2007, the pre-Great Recession, the pre-housing bubble burst, right? In 2007, October 2007, the market hit what was at that time an all-time high. Okay, and then of course, once the banks started to fail, once the subprime crisis began, we saw the market collapse, essentially cutting itself in half, dropping over 52% over that roughly year and a half period of time, bottoming out in March of 2009. Okay, and then since March of 2009 began the great bull market, this historically long, unprecedented bull market, right? Where the market just kept going up, okay? But it was not without its hiccups along the way. Almost every single year along the way, that historic bull market, we saw double-digit or close to double-digit drops over a month or 2-month period of time. Okay, the first one came in about midway through 2010, where we saw the market drop about 16% before eventually recovering, or pretty quickly recovering. Then we saw another 16% drop in 2011, another 9% drop in 2012. So 3 consecutive years with some big drops sometime within that year period of time. Then it was wonderful. We had almost a full 3-year stretch with no significant drops in the market between about 2013 and mid-2015. Then later in 2015, 2016, we had consecutive drops that were both very painful. A drop of 9%, then it came back. Then a drop of 9%, then it came back. Okay, in about 2018, we saw 2 big trigger drops. Okay, one was right starting the year off, a big 10% drop in the market that later recovered, and then ended 2018 with a very scary 18% drop. Okay, now it was right after that initial 10% drop in 2018 that I began to pivot our investment strategy. Okay, we'd had about a 9-year period of time of this huge bull market from 2009 to 2018, and we'd had some dips along the way, but I started to get very worried about overvaluation in the stock market, too much speculation, and that's when we did our first pivot, where we built up the war chest. Okay, this war chest that we had from 2018, 2019 into the coronavirus crash of 2020. All right, so that was our first pivot. So that was in place already when the 18% drop at the end of 2018 hit. And then of course it was in place when the big coronavirus crash hit in 2020, where the market dropped, 32%. Of course, as we all know, it pretty quickly recovered and set all new highs right up until, mid-December of last year. Okay. And then since about mid-December of last year to now, we've had about an 8% drop. So there's another one of those, 8% drops, of which we've had, just a half dozen that I pointed out. We've actually had quite a bit more than that, but a half dozen that I've highlighted, over the last 15 years. Okay. So not terribly unusual. But the thing about the markets is you have to ride out all of these 8, 10, 16% drops so that over that 15-year period, you can triple your money, okay, which is what has happened over the last 15 years. So you have to be ready to weather that type of volatility in order to have the growth. That is what capitalism, that's what stock markets, that's what market investing is all about. Now, that's all fine and good, and it's helpful to look at history because it puts everything we're going through in context, okay? But as I talked about, we pivoted our strategy in 2018. And then what I want to share with you is kind of where we were at the last time we got together, okay? So in October of last year, when I let you know about what our new strategy was going to be, okay, I want to remind you about that and kind of share with you where we're at today, because investment strategy is all about preparing for what is going to happen, not reacting to what is happening. If you're reacting, you're too late, right? It's already upon you, okay? So I'm going to share with you a little bit about what I told you the last time we got together. All right, so summarizing kind of our investment plan, right? In 2018, we began to build up the war chest. Then when the coronavirus crash hit in 2020, we did the tax loss harvesting, okay? And then going through 2020, we were rebalancing back into a normal portfolio, okay? We took that war chest and we bought opportunistically until at the end of summer, or at the beginning of summer of last year, we were finally back to what I would call a normal portfolio, right? A pre-2018 sort of balanced normal allocation, okay? So we'd hit that normal in summer of last year. And then come October, I started to be worried about three big things, okay? One was the Federal Reserve beginning to pull back on its stimulus, okay? I was also worried about higher taxes. That has more or less gone along the wayside with the collapse of Biden's infrastructure bill, okay? The spending didn't happen, so it doesn't look like the taxes are gonna happen either. But who knows, that can change at any time. And then I was also worried back in October about a possible China debt crisis. That is still out there, though it's not getting nearly as much press as like the Ukrainian crisis right now with Russia. That certainly has the possibility for some problems also, okay? What is not specifically on here is the coronavirus, okay? And the reason is because the U.S. business has done what U.S. business has done very well, and that is adapt, okay? And U.S. business has adapted, okay? Corporations have figured out how to generate profits despite the problems with the coronavirus supply chains and the coronavirus employment squeeze, okay? Now, that being said, those problems are still there. It's just that it's nothing new. Those problems are already built into the market, okay? So we're not expecting to see huge price volatility because of the coronavirus, because that's been the new normal in the market, okay? But these three things were all new risks, new concerns as of October, and still today, probably two of the three are a concern. The higher taxes really aren't a short-term concern right now. Okay, so in light of those concerns, in October of last year, okay, we pivoted our investment strategy again. We wanted to make sure we could protect your portfolio from the bonds losing value or the bonds being volatile as the Fed began to change interest rates, okay? And we completed that in December of last year by adding structured notes to most of your portfolios, not all of your portfolios, okay? We only did it for clients who are either already retired or very close to retirement. My clients who are still in the accumulation phase of life, okay, that are still maybe 5+ years away from retirement, we did not do structured notes for you, okay, and I'll explain why in a little bit. And we also weren't able to do the structured notes for any clients who have portfolios under 500,000. It just wasn't, we're just not able to do that with a product like a structured note, okay? But many of you, we did that pivot, okay? Now for all of you, we continued to do the other three things, which were the ongoing responsive rebalancing, okay? Maintaining our very strong international diversification, okay? A lot of your investments are outside of the US, which insulates you from problems specific to the US, okay? Which is what we're going through right now with the Federal Reserve pulling back on interest rates, okay? And then we also dramatically minimized your exposure to any high yield or junk bonds, okay? Just because they're called junk doesn't mean they're always junk, doesn't mean they're always a bad deal. Junk bonds have a wonderful place in a portfolio, but given what we were worried about in October, we scaled that back considerably across the board in all portfolios, okay? So that's what we did ahead of time before the volatility really hit in December. Okay, so let's talk about the different portfolios that we have for you and what the returns have been like as we implemented that strategy in October, going into this period of high volatility in late December, January. Okay, so most of you have your portfolio will fit into one of these three categories, okay? Not exactly, okay, and it's important to understand your individual returns will vary from these numbers here, okay? But most of my clients have one of three different portfolio strategies that we do, okay? The top one is our growth strategy. That's for my accumulators, okay? Clients who are 5+ years away from retirement, have a long period of time before they need to touch the money. And so we can be more aggressive with those returns, okay? Target return for that growth portfolio is like 8 to 9%, okay? Most of my clients fall into the middle category, okay? Pre-retirement or early retirement. They're in what's called my growth and income portfolio with a target return of a little more conservative, a little more balanced, 7 to 8%, okay? Not so pedal to the metal like the growth is, okay? And then my most conservative portfolio that I use for most of my clients is my income portfolio, typically implemented for clients in late retirement. Okay, and the lowest target return, 5 to 6%. Now, all of these portfolios have dramatically outperformed the targets over the last 3 years. 2019, great. I mean, almost doubling the target across the board for all portfolios. 2020, right on track with target, despite the coronavirus crash, right? Right on target with the target returns a little bit higher. Okay, 2021, another great year, okay, surpassing the target returns, okay? And so one of the things that I've been communicating pretty consistently was it was inevitable that we had a 1 or 2 year period of time where returns were not going to be above target, okay? It is unlikely, extremely unlikely, that you continue to outperform the target return for a portfolio year after year after year after year. So we may be going into a 2022 and or a 2023 where returns are much lower than what we've kind of come to get used to, okay? I'm thinking low single digits or at most, mid single digits. So anywhere from 1% to 3, 4, maybe 5%, okay? I still don't think that we are in for some big negative years, okay? I do not think that is what is coming our way. But to start off with a bad January, I think is relatively normal, Okay, across the board right now, year to date, portfolios are down about 4.5 to 5%. Okay, so that's what your portfolios have dropped so far in January. Okay. All right. Yeah. Okay. So one of the things I want to focus on is kind of like tried and true investment philosophy, right? Because when you lose in investments is when you change your philosophy mid-stride. Okay, you need to have a philosophy and have the investment discipline to stick with it. And I think nobody is more symbolic of that idea than Warren Buffett. Okay, also called the Oracle of Omaha. And so I feel like in times like this, where the market is volatile, where it's a little bit scary, where we begin to question what our strategy is and is our strategy working. Okay, it's kind of important to learn from a guy who's been doing it incredibly well, for over 60 years. So these are some of my favorite Warren Buffett quotes. Okay, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Okay, this is going out to all you cryptocurrency buyers out there. Okay. All right. The most important quality for an investor is temperament, not intellect. Okay, most of us, if your investment strategy is gonna fail, it's gonna be because you let your emotions take over, right? And you abandon your strategy. Okay, you change your investment philosophy. Okay, risk comes from not knowing what you are doing. All right, and that's why all of you guys have chosen to work with me. Okay, because this is what I do day in and day out. This is my job is to protect you guys from a failed investment philosophy. Be fearful when others are greedy, and be greedy when others are fearful. Okay, this really goes to to anybody who is sitting on the sidelines right now, scared to invest their money. At times like this, when the market is volatile, as long as you have an appropriate time frame, there are lots of wonderful buying opportunities. Okay, for those of you who we already have an investment portfolio implemented for, that's where the rebalancing comes in. Okay, as long as there's something up that we can sell in order to buy low, we're going to be doing it all along the way. Okay. Again, this is kind of going to the idea of cash, right? Today, people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. Now, that being said, an appropriate amount of cash is absolutely essential for all of you, okay? And we spend a lot of time talking about cash and the role of cash in your portfolio. You have to have enough cash in order to provide you with the cash flow necessary to ride out the bad times. Okay, and we don't know how long those bad times are going to last, and that's why I'm always advising all of you on how much cash to be keeping on the sidelines. But don't be keeping a crazy amount of cash, because as Warren Buffett says, it's a depreciating asset. Okay. This is one of my favorite ones, and you can take my little forecast of portfolio returns the next 2 years to heart when you hear this. Forecasts may tell you a great deal about the forecaster, but they tell you nothing about the future, and that is absolutely true. I can guess at what's going to happen the next 2 years, but I do not know, nor does anybody else. What I do know is what it takes to protect your money in case something happens. And that's the best that we can do, is identify what the risks are that face you individually, and then build up the protection so that if those risks manifest, we have a plan in place. Okay. And if any of you feel like we don't have that for you, please do reach out, because that is my main focus as your financial planner. And then finally, the best chance to deploy capital is when things are going down. Okay, so if we do go through a period where January turns into February, and February turns into March, and March turns into April, and we're seeing down markets, that's when we're going to look to buy, because that's how you make money investing. You buy low, you sell high. All right, that's the end of my pre-prepared marks, but I do want to talk a little bit, adding some color to what the Fed is up to right now and the concerns about what the Fed might do this year, okay? Going back decades and decades and decades, okay, the Fed had two main tools in its toolbox, okay, in order to impact the economy. It had the reserve requirement, okay, which is how much of a bank's capital it's required to keep on deposit and it can't lend out, okay? And then the other one was short-term interest rates, okay, specifically the federal funds rate and the prime rate, all right? After the 2008 crash, the Fed invented a new tool in its toolbox, okay, called quantitative easing, okay? The Fed was no longer okay with only controlling short-term interest rates. They now wanted to control or influence long-term interest rates. That's what quantitative easing is. The last decade plus, the Fed has been artificially keeping long-term interest rates low by buying up long-term bonds. That was fine. It had its place, okay? But one of the problems with federal intervention in long-term markets is it creates artificial prices, and that can lead to bubbles, right? And that can lead to problems. So the trick that the Fed has never been able to figure out is exactly how to undo what it did, okay? How do you go from a place of artificially keeping long-term interest rates low to now a place where the market can take over and create through supply and demand true long-term interest rates? That's where the volatility right now is coming from. Market participants don't know how quickly the Fed is going to pull out of that long-term interest rate manipulation, and they don't know whether they're going to do it too fast or too slow, and what the possible impacts will be, those ripples that can happen throughout the markets as they go from controlling long-term interest rates to a place where the market is controlling long-term interest rates. Now, it is a very healthy thing for the Fed to pull out of its long-term interest rate manipulation, okay? That we do not want that in place in the long run. But you better believe it's going to be a little bit of a rocky ride as they go from total market manipulation to hopefully a point where there's little to no long-term interest rate market manipulation. Because we want them there when the next crisis comes, which hopefully there won't be, but you know, there always seems to be. Okay, and so that's the best we can hope for, is that the Fed is able to pull out of the long-term interest rate manipulation and its quantitative easing with as little impact on the economy as possible before the next downturn begins. So that's what we'll be watching for. All right, I can go ahead and open it up to any questions any of you guys might have that I haven't addressed. Go ahead and unmute yourself and maybe either you raise your hand or just shout it out.
John, Barry here.
Yeah.
When we have our individual meeting, which will be coming up shortly, that's when we'll know what bracket we fit into, because I'm not even sure the bracket I'm in yet where you're investing. So is that when we'll find out, when we have our individual meeting?
Yes, yeah, we discussed that specifically for you, what portfolio we have you in and what the performance has been, and what, if any, changes we've been doing in the portfolio.
Now, I get the Wall Street Journal every single day, and every time I open it, I go, why bother? I've got John. So I don't. So I am curious, is there anything that as an individual we should be looking at? I mean, not to say over your shoulder, but is there certain things we should be looking at? It doesn't seem like it. I kept trying to figure out. It seems like you've got us covered.
Well, I love the Wall Street Journal. I love the Economist magazine. I like anything that takes a little bit longer term view of what's going on in the economy. The problem with day-to-day market reporting is that it pretends that there's a cause and effect that often isn't really there. Okay, so there's, you know, on any given day, there's good news going on and there's bad news going on, right? And then depending on what the market does, okay, most news commentators, if the market's down, go, oh, it must be because of the bad news. And then if the market's up, it's, oh, it must be because of the good news, okay? Without anyone ever really knowing what the actual cause and effect is, okay? And so the problem is it creates an illusion as if there is that cause and effect when it usually isn't there. The only way you can begin to see any type of cause and effect is over not days, not even weeks. It takes months and quarters to be able to see, what is likely moving markets. So day to day, it's all just noise.
I have one last question, John. Do we have to be concerned with the situations, for instance, like when we read that, Tesla has X number of billions of dollars in shares, but yet they've sold 25 cars compared to General Motors? That is there going to be some sort of balance that you're watching out between those companies, and should there be? This is more out of just curiosity.
Yeah, no, good question. So my investment philosophy is one that I do not pick winners and losers within a particular industry. Okay, we do what's called index investing. Okay, which is where we invest your money across a broad swath of U.S. companies, both large companies, mid-sized companies, and small companies. Okay, we do not try to pick the winners and losers within those categories, and the reason we don't is because there's lots and lots of scientific evidence that shows it doesn't work, right? And so why try to spin our wheels trying to do something that's going to cost you money and is not likely to work?
It makes me feel very comfortable. Thank you, John.
Other questions? Yes, Michelle.
Hey, how are you? Greetings from Texas.
Yeah.
Two things. Inflation.
Yes.
I think, well, let me back up. I think one of the things that is unnerving to me, since, income, it slows down once you retire, is number one, there's so much going on in the world that has no precedent. And it's so hard to say, well, over the last, like you explained, and I know it's all we have to go by, it's history. Unfortunately, it's just a comment. It feels like there's no precedent for some of these things. And it's very hard to say, oh, well, it always comes back, or it always does this. You know what I'm saying? So that's a little unnerving for me anyway. And the other thing is the inflation thing is being retired and having inflation go up the way it has so dramatically, so quickly, our buying power is so much less. Mm-hmm. And that's scary. So I was just curious how you thought about, you can listen to 10 different pundits and you get 10 different, is it transitory? Is it permanent? Blah, 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 blah. Yeah. So I'm just curious how you feel about that.
Yeah. So that was actually one of the big themes of my October call was I'm not worried about inflation. And all the reasons why I'm not worried about inflation right now, because even though the inflation rates today are relatively high compared to what we've become used to,
right?
Historically, they are relatively normal. Okay. And so when it
all came at once.
Yeah, exactly. It came
fast, straight up.
It came very fast. Yeah. And I am one who believes that is largely, though not entirely, but largely due to supply chain issues. Yeah. Okay. But it is ridiculous to think that it is entirely due to supply chain issues. And so the question is, how much of that dramatic increase is here to stay and how much is transitory? Okay. And then the question is, do we care? Okay. Does it put us at financial risk? And one of the things that I kind of tried to drive home last time is inflation is only a problem if your portfolio and your net worth and your income don't keep up with it. Okay. Right. And if you are a stock market investor, as all of you guys are because you work with me, okay, stock market returns have been far in excess of normal. And so it's okay if for a little while, inflation is in far excess of normal because you've had the portfolio returns the last 10 years to keep you way ahead of the game. Okay. And so the big question though is, does that continue? Okay. And again, that's probably something I'll have to dive into with you a little more individually, share with you a little bit about what I shared with everybody in October and why I'm really not concerned about it. But yeah, thank you for the question.
Sure. Thank you for doing this.
My pleasure. All right, any other questions before we sign off?
Hey, John, it's Greg.
Hey, Greg.
Hey, just curious, have you put any thought into the Ukraine-Russian scenario and what type of volatility might take place if in fact things escalate?
Yeah, so here's the thing about war, is it doesn't tend to be terribly bad for the US economy unless one or two things happen, okay? One, it's infrastructure destroying, okay, which hasn't happened in century, right? Or two, if it's a dramatic shift in resources, okay, resources being manpower or production, okay. It's probably unlikely a war with Ukraine would end up in either of those two things, either infrastructure destroying or a dramatic shift in deployment of resources. I mean, in our entire 12-year war with Afghanistan, there really wasn't a shift in resources, that really changed anything. So does it have the potential to be disastrous? Could we end up launching nukes back and forth? Of course, but is there anything I would do with the portfolio in light of the fact that we could end up in a skirmish? No, I don't think so. I think unfortunately it's kind of like no effect or like dramatic doomsday effect, and there's not much in the middle that I think is likely. So,
Gotcha.
hopefully it's not doomsday. All right, other
John,
questions?
John,
Yes.
John,
Hey,
it's
Laura.
Laura Bearer. Hi, I just have a more colorful question maybe for you. This has nothing to do with my portfolio, and I understand where I'm at. But I just have a question because I have a younger son and I hear so much from people in their 30s about cryptocurrency. Do you have any thoughts on cryptocurrency and how that's going to evolve? Is it actually real? Will it become more real?
Yeah, cryptocurrency. First off, cryptocurrency falls into the category of investments called speculative investments, okay? A speculative investment is any investment where the value is not based on any type of fundamentals whatsoever. Okay, and there's lots of investments out there. Okay, the classic example were tech companies in the late 90s. Okay, tech companies in the late 90s were a classic example of a speculative investment because the prices were skyrocketing without any fundamentals whatsoever to validate them. Now that ended up being a tech bubble burst, but it did not go away. Right? We have a thriving tech industry today, which is now out of the category of speculative and now very much in the category of mainstream, where there are profits and there are profit growth to justify a stock price. So for me, I include no speculative investments in my clients' portfolios. I don't think it's appropriate for my clients until they become the type of investments that have some type of value justification. My own thoughts on cryptocurrency is until it becomes a regular medium of exchange, it's not real. And so it could easily just be a tulip bubble, which if you want an interesting read, Google tulip bubble. But it could, it could over the next 50 years become a legitimate medium of exchange. I don't think so though, but
yeah. You've answered my question. Thank you very much. That really helps me understand. I wasn't looking at it for myself. I'm obviously not in that stage of life, but I just have heard so much about it. There's been so much written about it. I now thank you for just helping me understand that it's purely speculative. It's not based on anything real, and it could evolve or it couldn't. But yeah. I hear what you're saying, and I really appreciate you helping me understand that.
My pleasure, Laura. All right. Well, thank you very much. Oh, yes.
John, I just have one more thing that's not, and again, if we want to take this offline, that's fine. I'm curious though about one thing. I keep reading that there is a job vacancy that is unbelievable and that no one's able to fill it. And I'm curious about, and as I said, this has nothing to do with our investments, but I was curious from your point of view, how are people not filling these positions? How are they staying alive? Are they just talking about retired people that aren't back in the workforce? What's going on here?
You know what? I don't have a good answer for that. It is a big mystery, and I haven't read anything that convinced me, this person has the answer. I don't know.
Okay.
It's weird. It is
Yeah.
it's a true economic dislocation, where 2 points you feel like should meet up and they're just not meeting up. And that's a dislocation. And I don't know why. I don't know what needs to happen in order to resolve that either.
Thank you, John.
Yeah. All right, everybody. Thank you so much for attending. I hope it was valuable to you. I know it was fun for me. I'm going to send out this recording. Please do share it with anybody who you think it might be valuable to. And if you do have any specific questions that pertain to you, please don't hesitate to follow up. That's why I'm here.
Thank you, John.
Thank you, John.
Thank you, John.
Thank you, John.
Here, everybody.
Stay safe,
Thank you,
everybody.
John.
Stay safe. Bye.
Bye, John.
Bye-bye.